Ladies and gentlemen, the stock market today is volatile. It's coming under pressure. You have crazy numbers coming out from the UMISH survey today, indicating we have a huge problem. The bond market continues to implode. China has raised their tariffs on US goods to 125%. And, well, Larry Fink says we could already be in a recession. I mean, today, for the lack of movement we're really seeing in markets, again, it's not a great day. It's not a really bad day, at least at the time of recording this video. The S&P is almost break even, but yet it has been pretty volatile. Now, here today, there was an escalation in the trade war. China raised their tariffs on U.S. imports to 125%. And the U.S. warned China against retaliating in private talks. But let's be honest, China does not get a lot of goods from America. What they do get a lot of goods from America is like the farmers. That's why there's a lot of talk about, farmers needing a bailout or whatnot, because between the US and China, you really can't do any business between the countries. You have to circumvent that to other countries, but now the tariffs put on other countries kind of prevents that. We'll see what happens since the tariffs are technically paused. Like China, for an example, can send their products to India, send those from India to the US, right? Circumvent the 145% tariff directly on China. That's what they've been doing for a long time, right? Ever since Trump put tariffs on China in 2018, that's what they've done. So I don't really think the numbers here matter too much. You already can't do business between the countries. So I just don't think it's important what the numbers look like at this point. Whereas some people are going to react to this and think it's a big deal. It's really not. The damage, in other words, has long been done already before tariffs hit 100+% by each country. BlackRock CEO Larry Fink says we're very close, if not in a recession already. He said this on an interview on CNBC, which, sheesh, that doesn't sound good. But that's kind of the strange part about how we kind of calculate a recession. If you look at the Atlanta Fed GDP Now tracker, Atlanta Fed GDP is tracking negative 2.4%. If you exclude gold imports, which for whatever reason were really high this quarter, you're still negative 0.3%. Now, technically, that's, if Q1 is going to be negative, that's 50% of a recession, right? You're 50% already in a recession if a recession's 2 declining quarters of GDP growth. Now, next quarter that runs through June, or until June, we won't really know if we're in a recession, even if Q1 GDP is negative, until July or August, right? By then, you should have already priced in the recession, right? That's just markets tend to price things in ahead of time. So it is very true. We could already be in a recession. Larry Fink is correct on that. India's Foreign Minister Goyal says India is not encouraging investment from China. So kind of, again, backing away from the pro-China stance as some countries have done. Now, India and China, they've never gotten along. They literally fight each other on the border, like hand-to-hand combat. So not super shocked by that. JP Morgan CEO Jamie Dimon says, my guess is that a lot of companies will remove guidance, which is going to make markets a little weird, because if we don't have guidance to go off of, how do we, it's anyone's best guess to what earnings are going to look like and what valuations should be, could dramatically change from that. A source familiar with the talk says the first deal with another country over tariffs is weeks away. Donald Trump told me yesterday, this is a Fox reporter on X, quote, I think it's very close, but we have to have a deal that we like. And Trump says that about 75 countries have approached the U.S. about working out a deal over tariffs and non-tariff market barriers to U.S. products. Wells Fargo's CEO says consumers have remained resilient. And Trump calls for an end to daylight savings time. We also did get the Michigan Consumer Sentiment Survey that came out this morning. The markets actually didn't move too much based on it. I think there's just a lot of volatility from tariffs at this point, and it's not the biggest deal. It's very political. We all know that. But the numbers did come down a lot. We were expecting 54.5 for the headline number. We came in at 50.8. So that was definitely on the weak side. 5-year inflation expectations, this is your longer run inflation expectations, were expected at 4.1%. Last month they were at 4.1%. This is the highest level you've seen in like 30 years. Well, forget that. You rose to 4.4%. Again, it's political. Democrats expect hyperinflation. Republicans expect no inflation. Independents, while their inflation expectations have been moving higher, they're still only at like 3.5% or so. Okay, so it's very politically skewed. Keep that in mind. But longer run inflation expectations within this survey are moving higher. Now, consumer expectations were last month were 52.6. They are now 47.2. So markedly worse there as well. And current conditions really plummeted from 63.8 last month to 56.5. That's like an 8-point drop. That's huge. 1-year inflation expectations skyrocketed from 5% to 6.7%. Even when CPI was 9% in 2022, nobody thought, this survey was nowhere close to where it is today. In fact, when CPI was, call it 9%, the highest you got was like 5.5%. Today, you've just, it's vertical, right? November of 2024, you were at 2.6%. You've almost tripled since then. Now, again, usually this has been a big catalyst as of recently, but we've had so many big events as far as trade and tariffs and recession concerns and the market selling off in general. This was not the biggest catalyst today from that perspective. Within the UMich survey today, the share of consumers expecting unemployment to rise in the year ahead rose to the highest levels you've seen since 2009, which clearly was not a good time for the job market. Fed Musaliam says firms say they expect to raise prices due to tariffs, but also report consumers are increasingly price sensitive. He says, I am closely monitoring whether the rise in near-term inflation expectations seeps into longer-term ones. He says the downside risks to growth and employment have increased, and there are notable headwinds for the labor market. Because, again, let's face it, if you're a company and you're subject to these higher tariffs, you're not going to be able to pass on that cost to consumers. Maybe a little bit of it, maybe, but not even close to enough of that cost. What you're going to have to do is make up that margin internally. And one way you do that is firing people. If you have 3 employees that you need to do a certain task, if you can get away with just 2 of them or even 1 of them, you're going to do that in this new tariff environment. And there's also something quite psychological that happens. If you're a company and times are good and everyone's hiring and kind of like we've seen over the past couple of years, you don't want to be the only company coming out and firing people. That's not a good look. But if everyone starts to announce layoffs, then it's a lot easier to get away with announcing layoffs. Same is true with not giving guidance. Like if nobody's giving guidance, then it's okay to not give guidance because nobody's giving guidance and there's really no other, benchmark to look at, right? Same thing with missing on earnings, right? If you're the only company that misses, that's bad. But if everyone is missing, not as bad. It's the sheep, herd mentality. And that is very important, I think, at a time like today, especially heading into earnings season, because you are not going to get a lot of definitive answers from anyone. This uncertainty is going to be with us for quite a while. Fed Musaliam says uncertainty is high, Fed policy is well positioned. Fed Musaliam says inflation expectations must remain anchored for a Fed policy that's responsive to both employment and price stability concerns to be feasible. And if you guys just want my opinion, I think the Fed is way too nervous here. I think they're going to completely miss the economy. There will be a policy error from the Fed at this point. They are not going to step in nearly fast enough to save the economy. They should be stepping in with rate cuts soon, like now. It should have already happened. Okay, the Fed's nervous about tariffs and what that'll do to inflation. They're not paying enough attention to the growth side, to labor markets. And unfortunately, that's a bad position to be in as investors. At the time of recording this video, just taking a look at the broader indexes, the Dow is down 0.77%, S&P is down 0.83%, NASDAQ down 0.87%, Russell 2000 down 0.55%. The VIX is up 11.2% today to 45.29. As I've said before, the VIX above 40 is really critical. Like, that is crisis level, okay? 10-year Treasury yields up 16.5 basis points today. Oh my gosh. The reason Trump announced this pause was really to pivot and stabilize the bond market. He could care less what happens to stocks. Well, that has backfired in an epic way. I mean, it's really bad. And at any moment, I would expect the Fed to step in here because you gotta save the bond market. You have to. Or you could have bank runs. You're gonna have blow-ups. You're gonna have a much larger economic problem. And the Fed at this point just doesn't sound concerned, which is another reason why policy error is starting to look more likely from the Fed. Because on top of all of the uncertainty you have on trade around consumers and consumers slowing down in general, corporate America in general, now you have interest rates that are skyrocketing. So if all of that wasn't bad enough, now it's going to cost a lot more if you need capital, if you want to expand your business, if you want to buy a house or whatever. Not really a good cherry on top of the shit show Sunday, if you ask me. We did have big bank earnings. JP Morgan, BlackRock, Wells Fargo, BNY, and Morgan Stanley. Fastenal also reported. Generally speaking, earnings were pretty good, especially the trading segment of these banks, which makes sense. There's been a lot of volatility. There's been a lot of potential opportunities, but none of these really stand out as like a problem. Now, we're going to go over some headlines, especially from Jamie Dimon and JP Morgan's earnings in this video. But so far, major banks, they're not this big red flag for what earnings season could look like. Although banks are probably not the first area that would feel the economic pain. Believe that or not. So let me know what you think about all of this information down below in the comment section. Specifically, you want to pay attention to the last 30 minutes or so of trading today. How do people position for the weekend? If people buy stocks into the weekend, that's a good sign. If they don't, if they sell our markets heading into the weekend, that's a risk off sign for next week, in which we start to get more earnings coming out next week. And that's really going to be the biggest story of the next couple of weeks is earnings. What do companies say? The lack of guidance, I think, is going to be huge in this earnings season. Nobody's really going to know what to expect from companies this year, let alone this quarter. So let me know your thoughts on this down below in the comment section. Have a great rest of your day. Have a great weekend, and I will see you in the next one.